Welcome back to the new Blueprint strategy course and welcome to Module 3, Fundamentals for Market Setups. Module 2 was all about the analysis of price. We looked at location and direction on a higher time frame to identify bigger picture context in terms of the current trend condition, as well as areas of price that we would perceive as very low, low, high, very high, or equilibrium. These were the areas where we would expect price to turn if, caveat, it's also within the right context of fundamentals. So this is what we can see. We see price. However, what's the issue with price? Well, what we see is only a representation of the underlying fundamental condition of the market. So we can see the iceberg or we can see the tip of the iceberg. However, what we cannot see just yet is what is hiding below the surface. Now, let me explain this. Price can easily be distorted and manipulated by institutions, right? What is perceived as low can always go lower. What is perceived as high can always go higher. Just because we can identify an uptrend does not mean that we would buy. And just because we can identify a downtrend does not mean that we should sell. Oof, I wish it was just that easy, but it just ain't so. So we need more than just a comprehensive understanding of price to predict the future, because as we understand, price does not drive price. What drives price are, in fact, the underlying fundamental market conditions. And this is what most traders lack. This is what they don't see. Now, most traders lack a deep understanding of the key fundamental drivers of the markets they trade. And this is where our fundamental forecasting tools, or in short, our campus indicators, will come into play. So the art of forecasting, or in other words, the art of finding the markets that set up the best, is a combination of higher time frame technicals and fundamentals. Higher time frame technicals plus fundamentals equals a good trade setup. Let me repeat that. Okay, everyone write this down. Higher time frame technicals plus fundamentals equals a good trade setup. Higher time frame technicals is what we can see within our price charts. That's the location and direction analysis. Part of our fundamental analysis will be our campus indicators. So there will be the COT index as well as the net positions. There will be the valuation tool and the true seasonality that also comes with a true seasonality radar screen. The COT, the Commitment of Traders report, in short and easy terminology, allows us to follow the smart money. And this is what we will cover today. However, we'll have to cover the COT in multiple parts of one lesson, because we have to speak about the commercials, we have to speak about the non-commercials, and we have to speak about the retailers. So we have to inspect 3 different groups or participants that act in the markets. Now, the COT, as we know, is mostly relevant for finite markets, but we also can apply this for our man-made commodities and or our infant markets as well. And we'll, of course, do a lot of practical applications here as well. Then the valuation looks at cross-market conditions. So it looks at key drivers of the markets, for example, interest rates for stocks and equity indices. And it then will look at the spread between how close together or far apart interest rates are versus stocks or equity indices. So that will give us a sense of value in the markets that we trade, especially looking at our infinite markets, which then our equity indices and our stocks are part of. And lastly, we also have our true seasonality indicator, and our true seasonality indicator will help us to identify dominant seasonal time periods, or in other words, seasonal reoccurring patterns. So in easy terminology again, it will tell us what are the times of the year that a specific market is most likely to be bullish and a specific market is most likely to be bearish. So this is also what this module is going to be divided into 3 lessons. Each of those lessons will cover each one of our indicators. However, for each of those lessons, we will need multiple parts. For the COT, we probably need at least 3 parts because, again, we need to speak about the commercials, the non-commercials, as well as the retailers. For the valuation, we need to speak about our infinite markets and interest rates as a cross-market condition to value our infinite markets. But we also want to potentially look at ways on how to value our finite markets, our commodities. So we'll also look at the storehouse of gold as a way of measuring value for our finite markets. And then lastly, for the seasonality, we need multiple parts because while we use and apply seasonality on all of our markets, finite, infinite, man-made commodities, the seasonality that we'll look at specifically may vary. So for stocks, for example, you know that we have a yearly roadmap. And so we'll look at election cycles, pre-election cycles as well. And so there are different ways on looking at seasonality. Depending on the markets that we focus on, we'll need to find the best seasonal pattern or cycle for that market. So this is what we'll cover today. We'll spend 1.5 to 2 hours talking about the commercials. But before we go and talk about the commercials, I just want to quickly talk about the COT in general. What does the raw data look like? Where can we find the raw data? What's our indicator based on? And what are some of the other market participants that are listed there, and how are they listed within the raw data? That will then help you to better understand the indicator as well. Then we will talk a little bit about the commercials, in specific how they make money in the real world. And then we'll go into a little bit of a history lesson of how old the COT data is, how it was published in the past, and how lucky we are today basically to get weekly updates of the COT report. And then we'll look at the COT net reports, and we'll look at the COT index, which is our indicator. And then we'll put some mechanic rules around our indicator. In my opinion, one of the most important fundamental setup tools in the marketplace can be found when looking at the commitment of traders report, or in short, the COT report. Why? Well, simply put, the COT report allows us to figure out what the big guys are doing in the marketplace, and it allows us to follow them. It also allows us to get an understanding of the bias of the general public, the small traders and speculators like you and I, for example, and whether they are, as a group, extremely bullish or bearish. So the COT data is published on the CFTC website. First of all, I want to show you the raw data that our indicator fetches. And so here you can see a screenshot that's taken from the website's report for Palladium as of March 14th, 2023. You can see the date right there. So the COT data that we're going to be following is, again, provided by the Commodity Futures Trading Commission. In short, that's the CFTC. And the CFTC is just the agency that governs and regulates the futures and options trading in the US market. So what the COT report then contains, it contains historical records of futures contracts traded under the US market and US exchanges. And it is broken down by position type, either a long position or a short position. And it's listed for these 3 different groups of traders. This report that you see right there, the raw data, that's then updated on a weekly basis every Friday, but it only shows data up until Tuesday or Wednesday. And therefore, this indicator, we have to mention, is lagging a little bit, but it's still extremely relevant and valuable to what we do. And anyways, as a reminder, this is a setup tool, right? This is not a timing tool. So if we navigate to the CFTC website, then under market data and economic analysis, we'll see the commitment of traders report. And here we can see all sorts of different formats of different markets. And the format that we'll be looking at is the legacy reports, because the legacy reports will spit out our 3 different groups, the commercials, non-commercials, and the retailers. And it will list their longs versus their shorts as well for all of the markets that we trade within the futures market. So again, it is a futures only report. Hence, we need to access the futures data, the central marketplace, to then also see the COT report as well. So there's the CBOT, the Chicago Board of Trade. We have the CME, the Chicago Mercantile Exchange. We have the ICE, right, the Intercontinental Exchange. We have the NYMEX, the New York Mercantile Exchange. And under all of these long formats, you can see there's going to be futures and options combined. What we need to look at is the futures only. And then if we, for example, go at the Chicago Board of Trade, the CBOT, we look at the long format, then you'll get a list of all these different markets. So here you see wheat as of March 14th, and then you see corn as of March 14th, and then you see oats as of March 14th, and soybeans and soybean oil, treasury bonds, and what else is there? You have the 2-year treasury notes as well. Under the commodity exchange, you then find silver, you find copper, you find gold, and you find aluminum, steel even. So all these things we can trade, right? And then under the ICE, for example, what we'll have is we'll have cotton, we'll have frozen orange juice, cacao, we'll have sugar, we'll have coffee. Coffee we'll look at later when we do a practical application as well. We see the US dollar index. And so some of the Forex markets that we trade, like the euro, the Japanese yen, we can also find a commitment of traders report for Forex as we look at the Forex future symbols. So that's also going to become very important. So as I said, COT is going to be important for finite markets. Forex is an infinite, it's a man-made commodity, so it's an infinite market. However, partly we can also look at the COT report for Forex, but not for all Forex markets, but for some. And then NYMEX, for example, New York Mercantile Exchange. We have palladium here, for example, and that is as per the screenshot that you see on my PowerPoint slide right there. And what this report now tells you, it tells you the reportable positions versus the non-reportable positions. So the reportable positions, those are your large traders, your commercials and your non-commercials. These are your institutional traders. They're so large, they're by law required to transparently show and open their books to the CFTC and say, this is how many longs we have open, this is how many shorts we have open, and they have to do this once a week. So they are regulated. They by law are required to do this. And then there are the non-reportable positions. So basically you and I, no one really cares what we do, right? We're so small. So you would say, well, how is this data then listed if we don't have to report it? Well, basically, they know the total number of contracts that are being traded because it's being traded on a central exchange. So the NYMEX is a central exchange. All of our contracts, regardless of where we place those contracts from in the world, are going to flow through this one central marketplace through NYMEX, and they're going to be listed. So there's going to be a total contracts traded, and then they know how many reportable positions are there as well. And so the delta, the difference, is then going to be the non-reportable position. So they know, well, this is the total, these are the reportables, there are some leftovers. So the leftovers, they have to be the non-reportables, they have to be you and I. So we know that the non-reportables then as a result is you and I, so it's the retailers here. So we've got the non-commercials, we've got the commercials, and we've got the retailers. And then it's listed by either a long position or a short position for the non-commercials. For the commercials, again, either a long or a short, and then for the non-reportables as well, either a long or a short, and that's all based on contracts. And that's as of March 14th, 2023. So if we look at this here, for example, the commercials, who are usually the smartest money in the game, right? So they're the users and producers of these commodities. They're the biggest participant in the game. So we can see the total long positions of approximately 8,000 contracts and short positions of roughly 1,200 contracts. And then the non-commercials, so these commodity funds and other large traders, at this time, they were long 2,000 contracts roughly and short 8,700 contracts. And then the general public, so the retail trader, the non-reportables, they are long 1,000 contracts and they are short 1,500 contracts. So how would we now display this within a chart? Well, we could look at palladium. So here's the symbol for palladium. And I would then go to add study. And then you would just add Campus COT, users and producers, if you want to see the commercials, retail traders, if you want to see the non-reportables, and the fund managers, if you want to see the non-commercials. So in this case, if you want to see the commercials for today, I'm going to click on that. And now, oops, I clicked at the fund managers here. 1 second. So now we see the Campus COT users and producers, and you see this number 7,419 and 7,419. These are contracts and these are net contracts. What does it mean, net contracts? Net contracts is we're looking at all the longs and then we're subtracting all the shorts, and then you're left with a net contract size. So as a group, the commercials, the users and producers, the higher the line goes, the more they're technically buying, the lower the line goes, the more they're technically selling. Okay, so the correct terminology here is accumulating, distributing. But the higher these lines go, the more they're buying. The lower these lines go, the more they're selling. So we could now look at the commercials, the longs versus the shorts as of March 14th, but the report as of March 14th is probably not yet baked into this indicator right here, as I said, because there is a delay of when that data is reported and then when that data flows into the indicator as well. There's going to be roughly always about a week delay or maybe more. However, we take that trade-off of the delay because anyways, this is a setup tool, right? It's not a timing tool. And most of the time, these extreme readings that we'll be looking at, they'll stay for quite some time. And so we do have some time to position ourselves, even with a week delay here. So if we were to take you can take your calculators out now if you want. I'm going to do this. So if we take the 8,194, 8,194, and then we subtract the shorts, the 1,205, 1,205, then we should get a 6,989. And so we can see at the moment we're at 7,419 contracts. So that must have been the prior week, right? How would we check if that's the prior week? We could simply check by looking at the changes in the commitments from March 7th. And here we can see the changes of the commitments of those traders. So they reduced their longs by 614 contracts and they reduced their shorts by 184 contracts. So if I was to subtract the 614 from the 8,194, and if I was to subtract the 184 by the 1,205, and then again I'm subtracting the result here, the prior longs versus the prior shorts, then exactly I would fall within the 7,419 contracts. And so we know, okay, this is from last week. It seems like March 14th is not yet baked into this indicator. So now we're getting a line graph. And what we now can do is we can now track and study the activity of the commercials, the users and producers throughout history and then throughout time as well. So you can see now I get 20 years of data in terms of what the commercials are doing in interplay with price. Okay, so now all we need to do is we need to put that number here into context and we need to put some rules around, is this bullish or is this bearish? How exactly that will be done, we'll cover later. But for now, this is the net position that we can see for the users and producers. And the net position is just the delta longs versus shorts. And then we can see them as a group, how they behave over time and interplay with the charts as well. So let's talk a little bit about the commercials' key characteristics, specifically in terms of how they make money. Okay. So the commercials, the users and producers of the commodities we trade, they will sell higher prices and they will buy lower prices. Okay, so let me maybe illustrate this using a palladium example. So if I'm a producer of palladium and I have a lot of palladium in my bins or in my storage, whatever the terminology here would be, I'm not sure. In other words, let's say I have a lot of supply of palladium, and my break-even point of selling my supply of palladium is, let's say, $1,000 per contract. Now let's assume palladium prices, they go from $1,000 per contract to $1,100 per contract. What am I going to do? Well, I'm going to sell some of my palladium. If the next day it goes to $1,300, then I'm going to sell more. If then it goes to $1,500, I'm going to sell more. And let's say it goes to $2,000 per contract, then I may sell all I have and even more, because those are leveraged markets. This is a key characteristic of the commercials. They usually buy weakness and they sell strength because they do not speculate. Okay, they're not speculators like you and I. They're in this market to facilitate their business activities. And then in turn, this is how they make money. And this is why they are potentially the most important group for us to follow when it comes to the finite markets. They're also the biggest and smartest player in the game. And because their business relies on their ability to buy and sell the particular commodity, let's say palladium, at the most advantageous prices, they also usually have the best analysts on staff. They must have the best analysts on staff because their business relies on them buying and selling at the most advantageous prices. And so it just has to be that way, that circling back to Steffen's question earlier, who's more important, the non-commercials or commercials? Well, if we're looking at the finite markets, the markets that have a very short lifespan, so where it just goes from users to producers and then it's all over, right? So coffee beans are made into a cup of coffee and then it's all over. Gold is made into jewelry and then it's all over. Cacao and sugar is made into chocolate and then it's all over. Crude oil is made into energy and then it's all over. So the lifespan of our finite markets is very short. It goes from users to producers. These are the key players for our finite markets. So when we analyze our finite markets, gold, silver, palladium, crude oil, natural gas, it's going to be immensely important that we also look at the users and producers, because they will be the smartest money in the game for those markets. But the users and producers are not the smartest for all markets. So if we look at our infinite markets, for example, like Forex would fall into the category of infinite markets, because the central bank can always print more money, right? Or stocks will fall into the category of infinite markets, because a company can always print more shares and you can live your entire life without necessarily having to own the stock, right? You'll be fine. But try living without crude oil, try living without wheat, for example, or try living without gold. None of us can, right? Because gold, for example, it's not just in jewelry, but also important computer chips are made out of material gold. So we couldn't live without our finite markets. And our finite markets, they're scarce. Okay, there's limited resources. So there will always be demand, but there's limited supply. So we'll look at the users and producers for the finite markets, and for them, they'll be the smartest. They have to be, right? Because they're in the business not to speculate. They're in the business of trading millions of dollars of real product, and they want to make money in trading the real product. So they're facilitating trading of $1 million of real product through the futures markets. digitally. But here is now the catch, okay? So the most common misconception I hear from people when talking about the commitment of traders report is that when the commercials buy, prices will rally, or if they sell, prices will decline. Man, I wish it was just that easy. Unfortunately, it ain't that way. Here, for example, we can see that the price of palladium declines and the commercials are buying. And here we can see the price of palladium rallies and the commercials are selling. So it seems like they're wrong, right? It seems like they're doing the wrong thing at the wrong time. However, this is not how we are going to look at it. And also, this is what makes sense. Of course, they will sell into rallying prices, because the more price rallies above your break-even point as a producer, and you have a lot of supply of palladium, you're going to sell your supply of palladium. That's just what you're going to do, right? And so they act counter to what the price of the market does. They're almost hedging. So what we need to do is, rather than saying, well, they're selling or they're buying, rather what we need to do is we need to put their current buying activity as a group into the right context of prior cyclical extremes that had an impact on price. Okay, how can this be achieved? I'll show you later, but we'll have to put the current readings into context of prior extremes that had an impact of price. Okay, so we'll always need an anchor point. What that anchor point is, mathematically, it's very simple. We'll talk about it just a little bit later. Well, now let's talk a little bit about the history on and our ways on using the COT data. So what I wanted to point out here is the importance of the longer term outlook of the COT report. Okay, so very few people know this, but when the COT data was first launched in the 1960s, it was published only once a month, with a 2-week delay in the data. And then in the 1990s, they upgraded the COT data to be reportable twice a month. And nowadays, it comes with both, of course, yin and yang, that the COT data is being published weekly with only a 3 to 4 days delay in data usually. So what I want to say by that is that it's not only that today the COT data all of a sudden became relevant. The COT data had always been relevant to professional traders. And back in the day, traders understood that this report is extremely powerful when you put it into the right longer term context. Okay, and even if it was updated once a month, traders and investors, they were still forced to focus on the extremer pictures and extremer readings of this report that don't change that often and that take a very long time for commercials, for example, as a whole, for any of those groups of traders as a whole to get there. But today we can look at the new report every week and we see what they're doing almost without or with very little lag. And the more we look at it, the more we may lose the idea of the COT is supposed to be used as a longer term setup tool. It's not supposed to be a timing tool. It's supposed to be showing us the best setups in the marketplace. So how are we going to use it? We're going to use the COT data to predict the end of the band and lower time frame pivots. Okay, so I want to show you objective and mechanic ways on how to make use of both of these. So we would call number one, the higher time frame extremes or the end of the band. That would be in combination or subject to monthly supply and demand. And then the second would be lower time frame pivots, or in other words, lower time frame higher lows with the uptrend, or lower time frame lower highs with the downtrend. And so that would be subject to weekly supply and demand. So it's our job to make and to put this number here into the right context. Meaning, what we want to do is we want to put their buying and selling activities over the past weeks and months and years. Okay, I'm not just saying over the past week, I'm saying over the past weeks, months, and years into the right context of what the market is doing right now. Okay, so what we'll see oftentimes portrayed is that the commercials will continue to buy. The right terminology here is they'll continue to accumulate as prices go lower. Prices go lower, they continue to accumulate. The flip side of the coin is if you are a palladium producer and you want to sell your supply of palladium, you would sell into rising palladium prices. So you would sell into rallies. And the more price rallies, the more you would sell. Now, important to note here is that commercials, they're not actually shorting or selling. What they're doing is they're distributing product and they're accumulating product. That's the right terminology. However, for just making our lives a little easier, we can also use interchangeably buying, selling, shorting, going long, and so on and so forth. But if we wanted to be using the correct terminology, we'd have to say they're accumulating and they're distributing. Why are they accumulating and distributing? Because they are not speculators like you and I. They are business facilitators. Okay, so they facilitate their business activities through trading the futures market. And so the key takeaway here is that the commercials, as a result, they are most important to us when they are at an extreme reading relative to historical buy and selling activities. So it's going to be relative, right? It's going to have to be within the right context. So these are our findings here. This is what we saw by just studying the net positions. We saw that they buy lower prices, they buy into weakness, and they sell higher prices, they sell into strength, they facilitate their business activities, they have to have the best analysts on staff, their business relies on buying and selling at the most advantageous prices. And they are the most consistent participant in the game, all right? They're not always right. Sometimes they're wrong, but they're the most consistent participant in the game. And we would call them new trend anticipators. So whenever they're at multi-year extremes, that usually leads to long-term trends, weekly and monthly trends in the market that are going to be formed out of extreme accumulation or distribution of the commercials. And then so these historic and cyclical extremes, they are the best fundamental market setups. So there's a question, Bash is saying, why would a producer buy contracts instead of just buying raw materials to produce more physical to sell again? I'm not sure I quite understand this question. Maybe you can rephrase that question. Why do they facilitate? Why do they need the futures markets, you mean? Because their business relies on them selling and buying at the most advantageous prices. So if you look at the price of palladium, for example, you have just in the last year a price delta of $3,000 versus $1,500 per contract. So if you are a user or a producer and you rely on buying and selling at good prices for, depending on what's in your books, right, whatever the break-even point is for your cost structure, then whether you buy or sell at 3,000 or whether you buy and sell at 1,500 makes a huge difference for you. So futures markets have been put into place for the users and producers. And I believe if you watch the futures course, then you'll learn why futures and when futures were put into place. I believe it was in the Asian markets first where they started trading rice on the futures exchange, where when you trade a contract, it comes with a certain expiry date. So if you are a user and producer, then you have to plan with a certain cost structure too, right? So you cannot, you want to show a consistent price to your customers. So you cannot be abiding by constant market volatility. Otherwise, they couldn't be planning ahead. So that is, I guess, more a general question of why do the futures market exist, right? Why does any market exist? It exists for larger companies, larger institutional traders to facilitate their business activities, and only within, the last maybe decade and the last few decades, it's become with the leverage game, it's become also a sport, so a speculation game. However, that's why looking at the commercials is so beautiful, because they're not speculators, right? They're business people. They take rational decisions, and when they as a group are at extremes, we really want to be paying attention. So now I'm going to show you what an extreme looks like. So by looking at the net positions first, and by looking at palladium first. So if you're looking at palladium and you're looking at this area right here, you want to put that into context of the past weeks, the past months, and the past years, then you want to ask the question, are we at an extreme high reading of accumulation? Looking at the past year, looking at the past 3 years, or are we at an extreme reading of distribution over the past years? So in this case, if I was to look at all the prior highs of accumulation of the commercials, so their highest readings, this is now, okay, so their highest readings compared to this was a high reading, 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 this was a high reading. So what do all of these have in common? All of these have one thing in common, is that they eventually leads to multi-year bull markets in palladium. So right here in 2009, this led to a multi-year bull market in palladium. Then again, the commercials went to the same anchor point, right? This is the anchor point at this time. And then again, we could say, well, at this point, we could say, well, this is pretty high in terms of their accumulation. Then they get up there again. And then what we know is, well, if they're up there again, very likely is that this will lead to a multi-year bull market. And then that leads to a multi-week, multi-month bull market. And then again, they get up there in 2016, and this sets off a whole chain of rallies here. And then they get up there again very quickly. And then again, that sets up a chain of rallies. And then they stay up there for a very, very long time. And then we kind of have to put, these new readings into context of what's happening right now. And then you would say, well, this is high, it leads to a rally. This is high, it leads to a rally. This is high, it leads to a rally. And now this, without any doubt, is the most bullish that the commercials. And this is why I'm wanting to go through this today. And I'm going out on a limb here during this recording. That's going to be also here to stay for the Blueprint Strategy course, because what we're predicting, if we're doing an objective analysis here, is what we're predicting is a major multi-week, multi-months, if not multi-year rally in Palladium. Why do we predict that? Because the commercials, the users and producers of Palladium, the ones that have the best analysts on staff, they as a group are accumulating as much as they have never done before. Okay, they're not just accumulating as much as they have 3 years ago. They're not just accumulating as much as they have 10 years ago. They are as a group accumulating as much as 7,515 net contracts, as much as they have never done before in history of Palladium futures prices. So that for us is, for better or for worse, a signal that we want to buy. Now, remember, this is a setup tool. It's not going to tell us buy now, buy tomorrow, buy next week, or buy last week. It just tells us, hey, we wanna potentially look to buy. Why do we look to buy? Because we're anticipating and we're forecasting a major rally to come within the Palladium markets. And so Bash here is asking a very interesting question is, can the data be manipulated to trick readers of the COT? Yes, just like any data, most data can be manipulated, right? And they can get in and out of certain positions before and after they have to, share this data with the CFTC. But again, the commercials, they have no interest in speculation. They have no interest in manipulating the markets, right? Because if it was about manipulation for them and they're buying as much, then long time ago already price should have rallied. But the fact is that they're accumulating because the price is so low, right? And so this data is very rarely, when it comes to the commercials, when it comes to the non-commercials, the picture may differ. And then when it comes to the retailers, that data is anyways not manipulated. I'll show you that black on white. But just like any data, some data, there's always room for manipulation. But as you will see, as you will backtest, there's very little room for manipulation there within that data, because you don't just look at one commercial, you look at all commercials, right? So you look at 200 different participants. For Palladium, it's not that many actually. If we look at the players here, the total, so there's 66 plus 71. So there's 130 institutional participants. Well, here you can see number of traders, roughly 122 participants here that are institutional, right? So there's not that many that actually are in the game of being a user and producer of Palladium. That makes sense too. It's rather a small market. Smaller the market, the more it's prone to it's prone for manipulation. However, if you, for example, look at a bigger market, like for example, let's look at net gas. There it was. So natural gas, for example, they have 500, 440 participants. And then if we were to look at gold, we could do that. CME. They're not under CME, they're under commodities. Gold, there's 200 traders here. And here there were a lot more. So there's between 200 and also 400 participants. So there's a lot of participants. And so either they all meet, right? And we can talk about the conspiracy where all of those 400 major commercial participants meet in a room and they say they're going to talk to each other and they say what they're going to do. That's very unlikely. But what they know, obviously, they also know how to read the COT data as well. So the COT eventually becomes a self-fulfilling prophecy. So if we now look at this, going back to Palladium, if we now look at this, then we know with certainty, okay, and I can say this in a recording, in a blueprint recording, I can say with absolute certainty that this extreme reading eventually is going to turn into what? A multi-week rally of price. And I had this planned before today. Now today, the market's already moving 5%. But I had this planned as the market was down, in fact, so nothing I can do about that. But now the market tends to be rallying. And as you guys may be aware, we are positioned, and we can talk about that as well just in a little bit. But what we know with certainty is that the market will move into a multi-week, if not multi-month bull market. What we don't know is when that's going to happen, how soon that's going to happen, and from what price levels that's going to happen. That's not something that the COT can tell us, right? But we have other tools that then help us answer those certain questions, right? So from what price area should we be buying? Well, from higher time frame demand. Then you could ask, when should we be buying? Well, we look at the true seasonality to argue when we should be buying. We don't look at true seasonality to argue if we should be buying. We look at true seasonality to argue when we should be buying, when the commercials are buying, if the commercials are buying, right? And then we buy in a level of demand to time the market. So we use price, the analysis of price, to then say, okay, what is the location of price? Where is price most likely to turn in terms of demand? And if price is in demand and the commercials are buying, then I want to buy as well. So there will be two different strategies that we'll apply here. And around all of that, what we just talked about, we'll put some mechanic rules, and we'll put an oscillator, and we'll put an automated calculation around it, and we'll wrap it into a nice indicator so that we don't actually have to do manual labor anymore, right? We'll have an indicator that tells us, are the commercials accumulating? If so, how extreme is the accumulation? Is it maybe just a 6 months extreme? Is it a 3-year extreme? Or is it a historic extreme? And depending on how extreme the extreme is, okay, depending on what you use as an anchor point. So for example, if the commercials are at a historic extreme, then what we are talking about is the end of the band. So we are talking about higher time frame extremes. So the end of the band, the end of the bell curves, right? So of course, what is going to have to happen here is if I'm going to analyze price, and if let's say we're just analyzing price without analyzing fundamentals, then no one right in their mind would be buying, right? We could not be buying. Why could we not be buying? Because, well, it's a downtrend. We have been downtrending since 2022. And why have we been downtrending? Well, just put into place your pivot points here, right? And so what we have is we have consecutive lower highs. We have one lower high, one lower high, one lower high, and we have lower lows as well. And so no one right in their mind would be buying Palladium at the moment if you were just looking at technicals. However, if we are looking at technicals here and we are looking at the downtrend, right, then we know, hey, there's a downtrend, but we also know that the longer price is trending, the more likely it is for that trend to end, for us to go from a downtrend into a sideways trend. Okay, so we'll see the classic bell curve. So we go from that downtrend into a sideways trend, and then eventually into an uptrend. So that's a bell curve. And so why am I saying that the longer something is trending, the more likely it is for trend to turn is, well, the longer price is falling, if you're looking at the finite markets, then the more the commercials are accumulating. So I know by fact that if price is just downtrending long enough and the commercials have a long time to accumulate, eventually the commercials will be at an extreme. And when they're at an extreme, we want to be buying, right? When they're at an extreme, we want to be buying. So for everyone that is going with the trend, we have to be aware that it's not as easy as going with the trend, because by the time we see a trend, very likely the commercials are accumulating at extremes. So a lot of trend followers are oftentimes seeing the trends too late and then getting taken out as they jumped in front of a starting train. And so if we're looking to short here, for example, then we're looking to jump in front of a starting train, and usually a new trend is started with the beginning of an impulse move. And then by that time, it's too late. We shouldn't be selling anymore. We should be buying. We should be buying. Okay, so we've got the end of the bands, and the end of the bands are my historical extremes or my 3-year extremes. And we use that for anticipatory trend analysis. And what I'm going to overlay here is I'm going to overlay monthly and weekly demand. Okay, so if I see the end of the band extreme on the commercials or on any group, what I'm going to do is I'm going to look at monthly demand or at monthly supply to then get an idea of, okay, where is that market going to turn in terms of price? And then we have a trend following strategy, because we can all agree, well, if we had to wait for historical extremes and 3-year extremes to find setups all the time, then we'd be basically finding a trade once in a blue moon. And so we're in the business to find more trading opportunities, but not necessarily less quality trading opportunities, but just maybe shorter term trading opportunities. So we have what we call a trend following strategy, and that trend following strategy is looking for existing trends and then smaller extremes in terms of the anchor points terms of the look back that we're going to apply. So instead of looking back three years here or looking back throughout history, here we're only going to look back maybe 6 months, and then we're going to say, well, are we currently higher than where we were 6 months ago? Or are we currently lower than where we were 6 months ago? And how does that coincide with trend, right? So if they're high here and we're at an uptrend, right, and then all of a sudden the commercials are high here, then we're going to buy with that uptrend with those smaller extremes, let's call them. Okay, so there's two strategies. Trend following one, you look at smaller extremes, look at smaller cycles, and then there's the end of the band, the longer term kind of extremes. So how would that look like if we were to put in our indicator now, where it's going to get interesting? So it's a lot of building up knowledge, a lot of talking about the raw data. And now what we can do is we can just put all these findings into an automated calculation. We can put this into an oscillator, an index. Okay, we put some boundaries around our raw data. We wrap it, and then we just add the COT index V2. Okay, so now yours may look very different than mine. So what I'm gonna do is I'm first of all going to double click on this, and I'm going to show you and talk to you about the inputs that I have in place. So our 3-year look backs, they're going to be extreme readings whenever the blue line that's moving here is going above the 100% line. We look to buy. That's a 3-year extreme. And whenever it goes below the 100% line, we look to sell. That's a historic extreme as well. Historic extreme of distribution, historic extreme of accumulation. And then the secondary one is our historical extremes. And this we just see by looking at the COT net. Okay, so here on the indicator itself, you have a green, a white, and then a yellow line. And you can see to the right here the percentages of that index. And so here's the 100%, here's the 0%. So whenever the blue line goes above the white line and touches the yellow line, that's a 3-year extreme. Okay, so what I have on my indicator is I don't show the 100 and the 0 lines. Okay, and I'm going to show you how to play around with that and how to just visually put this, how it makes the most sense to you. So what I have here is starting with the first row here, futures only, or futures and options. So we put an option here to also ask for options data. Okay, so we bake this into our indicator as well. We don't use it, but just in case at some point we ever want to use that because we want to get into options trading for any reason whatsoever, then we could also technically look at their options report on the CFTC website. And that's just the legacy report here, futures and options combined. So that may be slightly different. For our sake of doing the analysis, we don't need options, we just need futures, and hence we leave a 1 there to go for futures only. And then we have our week's look back. Okay, so we have the 26 and we have the 312. So the 26 weeks, that's 6 months, that's half a year. 312 in this case would be 1 second, be 12. So 26 times 2 is 52. 52 would be a year. And then times 3 would be 156. So 156 is 3 years. And then 1 what I had before, 312 would be 6 years. So what your default setting, and for you, it may show the 312 here. What your default setting should be is 26 on the weeks look back and 156. So 156 weeks. This means that your anchor point will be the highs and the lows, the extreme levels of accumulation and distribution that were relevant in the past 3 years ago. So you're looking at a longer term cycle. So you're really looking at long-term buying and selling opportunities. And so for your historical readings here, so your historical highs and lows, we also have a certain line in place. So we have the line at 0 and 100, and I have a false here. So if I'm going to put a true here, then you can see that white line, that's now the 100 and the 0 line. And whenever the commercials go above the 100, then it means, hey, we're now at a 3-year extreme. Okay, so I just have the yellow in, because if I have the yellow in, it's basically telling me the same as the white one. And I just have a little bit of for me, visually, it just works better that way. So what I usually do is for the 100, the 0 and 100, I just leave that as a false. And then the 0 to 100 color, I don't need to change that because it's removed anyways. And then the -20 and the 120, I have a yellow color. So those are my extremes. So whenever the blue line, the commercials, whenever they touch the yellow, I know, hey, that's a 3-year extreme. And whenever they're above the green or below the red, I know it's the 6 months extreme or whatever week look back you're applying here. So my high percentage threshold, 80-20, those are my green and my red lines of the index. And then I can just call them to be green and I call them to be red. And then I can press default. And then every time you load this indicator, it will load like this. Then you could go again into your color here, and then you would see the commercials, the non-commercials, and the specs. So the commercials, you would want them to be blue. Well, at least I have them as blue. And then in terms of the style, you could say, well, how thick do you want the lines to be? I always want them to be a little bit thicker here in terms of the commercials. And in terms of your 120 and your -20, you could make them dotted lines here as well. Right? So now they're dotted. Now you can see it may be a little better. And then when you're happy with the view, then you could just press default here, and then it will apply. It should apply theoretically. So if I remove this now, and I'm adding this again, then you can see it's the same as I left it before, even though I removed it because I pressed the default button. So now we can see the commercials within an oscillator, within an index, and we're putting some boundaries, and by using a sophisticated calculation, we're making sense of whether they're at an extreme reading or whether they're at an extreme bullish reading or whether they're at an extreme bearish reading. And there's two extremes. There's a shorter kind of extreme that, that's just above the green line or below the red line. Those are like 6 months extremes. But then there's these really bigger picture extremes. And this is when the commercials hit the yellow line. Okay, so already by looking at the nets, right? And we're like, hey, we put all those lines on the nets. And then it's like, would our indicator have seen those? And we would say, yes, we saw it here, and we saw it even here, and we saw it maybe here, even a little bit too early. And then we saw it again here. And then the indicator was like just at a little bit of an extreme here. And then we saw it here. And then we saw it here. And then we saw it here again, right? And so our indicator picks up those extremes from left to right as the commercials go into an extreme. Now there's two types of extremes. We have the end of the band extreme. We're picking these up with the yellow line. And we have the 6 months look back extremes. So the 6 months look back extremes, this is our trend following rule, right? So whenever we see an uptrend or a downtrend, so if we see an uptrend and the commercials are above the 80%, above the green line, then we look to buy. And when we have a downtrend and the commercials are below the 20%, so below the red line, then we look to sell. However, we apply those only with either with trends or with sideways trends. If I'm in a downtrend, then I'm not looking to buy just because we get into the 80 percentile, right? If I'm in a downtrend and we're hitting the green line, I don't care, right? Because if we're in a downtrend, I need to see the yellow line, because the yellow line is the only thing that can change the trajectory of trend. The green line is only going to work in the context of an existing trend. However, if the trend is down and I'm below the red line, then you better know that I'm going to look to sell, right? Because if the trend is down and then we'll go below the red, then I can sell. Okay, so I don't have to be at the extreme here if there's an existing downtrend. So if I'm now going to remove the nets here, then it is fair to say that from these extreme yellow readings here, this was the start of an uptrend, right? So we have higher low, higher low, higher low. At this point, the only thing I need to wait for is if the commercials go and they go above the green, right? So if they go above the green at this point, you're gonna be rather bullish. And here we're gonna be bullish way too early, right? Way too early. And then price again goes into an extreme to then really go further to the upside. So we may look to buy here. And as we may look to buy, we may be too early here in this case, right? And then eventually, as we get the extreme reading, we should catch that again. And then right here we're spot on. We're spot on, right? And by the way, just because this is flashing green doesn't mean you're going to buy right away, right? We're still going to look for, in this case, some weekly demand. Here as well, we would look for weekly demand. And then this would be a nice buy point. This was a nice buy point. Here we're just a little bit too early. These were for sure the beginning of the new trends. And then we were, we are in an uptrend. So if we are in an uptrend, I don't care about the commercials being down there. If I'm in an uptrend and the commercials are down there, I don't really care, because that's just what they're going to do, right? They're going to hedge some of their positions. They're going to sell into those rallies because they want to take profit, and they want to make money in the real world. So I don't care as long as the markets are uptrending. And then there's Corona, and then with Corona, this is a big outlier here, so I wouldn't pay much attention to that. However, overall, if we continue to be bullish on Palladium, then overall, eventually, Palladium still remains to be bullish. And then after Corona, if we just see this as an outlier, then again, we're uptrending, right? We've got higher lows, then they're above the green line. And then again, what we see is market rallies. And then here we see eventually the end of the band, right? And then we see a shift in trend, right? We see a shift in trend. So what happens is when we see a shift in trend is, okay, the commercials will have to spend some time accumulating again. And only if they spend some time accumulating, prices will shift again. So here in this case, it just happens to be the case that here it did not work at all. It was too early, or it worked a little bit, but not very well. It was way too early, right? And that's also something that's going to happen, right? I'm not going to sit here, show you a tool that's going to have 100% success rate. So we're going to have to live with the times where we see a setup and the setup doesn't play out for whatever reason, right? And so then you ask, well, the commercials are the smartest money in the game. Well, yes, the smartest money in the game, but they're not always right. Even for the smartest money in the game, they're not always right. They're the most consistent in the game, as you can see, right? Eventually, these high levels of accumulation lead to massive rallies in price eventually. But the question is from where in terms of price, and when in terms of the calendar months or calendar years can we expect that? And then let's say eventually we're downtrending, right? So eventually we're downtrending, then we go below the red. So this is the only downtrend that we ever spotted in Palladium. So here we spotted a downtrend from lower high, but here we would have never sold, right? Actually, we bought this here. I remember this buy point here. This was also in the beginning of the year, which is a good seasonal spot. But here we could have never sold, right? Because they are at the yellow line, so the end of the band. Yes, it's a downtrend, but here we could have never sold. We have to buy. So here again, we have to buy. And then eventually, as the trend is down, if they're below the red, then we can sell with the trend. And now when they're below the green, we don't care. And now they're at the yellow. Now we're starting to care, right? Now we're starting to care. And we don't know when, but we know that it's just a matter of when the price will move into a now multi-week rally. So what you can eventually do as well is you can just backtest that your own as well. And so as you can see, what we need is we need to have an understanding of price in terms of what is the underlying trend condition. Based on the underlying trend condition, if I'm on an uptrend, if I'm within an uptrend, I'm fine with the commercials being above the green line. I'm going to look to buy. Where am I going to look to buy? In location low and very low, right? Weekly demand. And then when you have a downtrend, you're going to want to look to sell. If the commercials are below the red, where are you going to look to sell? In higher time frame supply areas. And when the commercials are at the yellow, I don't care what the trend tells us. I'm going to do whatever the commercials are doing at that point in time, right? So we could be, price could be wherever, I don't care, but I'm still going to buy within quality demand areas. So we have a question now from Zina. The 26-week look back versus the 156 weeks look back, they're plotted on the same blue line. Yes, they are plotted within the same index. That's correct. Well, that's the power of calculations, right? That's the power of calculations and not having to do it manually. So whenever the sort of averaged out, I don't understand. Well, whenever the blue line touches the yellow, that's you know, you don't have to be a mathematician here to understand the calculation that's baked into this. What you have to understand is that when the blue line is above or below, is above the green and below the red, those are your first week's look back. So in this case, they're set at 26. And whenever they touch the yellow, those would be your historical ones. Those would be your second ones that you put it here. So weeks look back 156, those are the yellow in this case, and then the 26, those are the green and the red. This one we use for trend following. This one we use for the end of the band. And then when we're at the end of the band, then we know very likely, because that's the one downside of an index, right? The one trade-off of an index is that we don't see historical extremes. Okay, we see anchor point extremes, but it could, as I look at 156 weeks, I could just be as high as I was 3 years ago. It doesn't mean that I'm at an all-time high, right? Maybe if I anchor a 3-year cycle, then maybe 5 years ago, they had a higher accumulation. So I don't know if what we're seeing today is historical in terms of it's an all-time high or it's an all-time low. But what we can do is this number 2 to see then the historical extremes. And this is only something that we would do if we see, okay, the blue line here is touching the yellow. If we're seeing that, then what I would do is I would just add the users and producers here to see the nets, and then I would look what's happening there. And as I see what's happening there, which is something that our index would not show, but it's also something that's extremely rare. It's so rare that it's you know, a 20-year extreme. I mean, this is super rare, right? The last time this happened was here. This back in 2021 was an extreme, a historical extreme. It led to a massive rally. We communicated it back then. This here was a historical extreme back then, right? In 2018, it was a historical extreme, and it led to a multi-week, multi-month massive rally. And then this one was historic, and then this one was just as high as this one. It led to a little bit of a rally. And now this one is again historic. And so if I just do the back testing on that and I understand how what the commercials do in terms of, now you're looking at the iceberg, right? Your iceberg is this here. This is the price that we see. And then the underlying fundamental condition, as we anchor that to prior extremes and as we get an understanding of if those prior extremes really matter to price, then we get an understanding of, hey, yes, they did. Okay, they did matter to price. How did price react from that? Right? Because clearly there is not just an interplay, there's a reaction and a representation of price that then reacts to whatever the commercials are doing, right? So if the commercials are at a historical extreme, eventually price moves higher. How much higher? I have no way of knowing how much higher. For how long? I have no way of knowing for how long. What I do know is that I want to position myself with a long, because we want to follow the smart money. Okay, we want to follow the smart money. Are you guys still following so far? And everything that we're building up towards now is trying to increase and enhance your understanding of our index here, right? I mean, I could make it a 5-minute lesson and I could say, these are the rules. If you're an uptrend, green, you buy. If there's a downtrend, red, you sell. If it's the yellows, you just buy and sell regardless of trend because it's anticipatory trend. I could make it very simple, but you need to know the underlying raw data and the power of that raw data to really trust and make sense of this indicator as well. And so the more you know, the better you can use that data, hopefully in the future. And then if you double click on that, you could change the inputs to whatever you would want, right? You could change the inputs to whatever you would want. So for example, you can see the speculators here, right? Now I'm teasing the next lesson. You can see the speculators here. And the speculators I could now put as true. And that would mean, who am I loading in now? I'm now loading in the retailers, you and I as a whole. Now, what are we doing here? Well, we're definitely going to buy, right? But what is the red line now doing? The red line is below the red line, which means that the red line is bearish. Well, who is the red line? The red line is the retailer as a group, just as the blue line is the commercial as a group. So the retailer as a group, they're selling. Of course, they're selling. I mean, price is going down like crazy, right? As I said before, no one right in their mind would be buying here. So they're selling and they're caught on the opposite side of the trade. Okay, and that's what we want to see. This is going to be our trade setup. Amplifier is, okay, the commercials are buying, but who's on the opposite side? Who are they buying from? Because the commercials, right, they're like Walmart. They have to buy from someone. They have to buy, they want to buy wholesale and then they want to sell retail. So they have to buy from someone. And so who are the sellers? Well, who's selling low down here? It's the retailers, right? So then whenever you see that the retailers are selling here, the commercials are buying, the commercials are selling up here, and the retailers are at the yellow line. They are more bullish than they have been 3 years ago. Not a good sign usually for any market. And then whenever the commercials are buying here, the retailers are on the other side, right? And so this is when we say the retailers usually do the wrong thing at the wrong time. This is not something that we just say. And here you can see the absolute extreme, which is the commercials are at the yellow line, the retailers are at the yellow line. Of course, this can only lead to a massive rally in price. There's no other way. So again, I'm going out on a limb today, and I had planned the session before we see a 4% rally in price. I'm going out on a limb. This is recorded, and what we're predicting is we're predicting a major rally. When is that major rally going to take place? And from where is that going to take place? We have to look at the full context. We have to look at supply and demand. We have to look at true seasonality as well eventually. But what you will notice is that, for example, if you're following the live sessions as well and the grid, and this is for all the newbies that are wondering, okay, what is the grid? If you look at the grid, then what you're seeing is, in terms of intraday swing and position trades, you're seeing our trades that we're taking, okay? We're taking these trades based on higher time frame technicals plus fundamentals, and then the price levels that you see is based on market timing, which is only the third layer, the third step of the process. We're not there yet. We haven't talked about market timing yet, but what you see here, this is going to be based on market timing, but we only time something when we have a good setup of price, a good setup in terms of higher time frame technicals and fundamentals as well. So here, for example, 1400 to 1300, if you go to Palladium now, and you go from 1400 to 1300, 1400 to 1300, right? So this was our drop base rally. This was our drop base rally. And then this is what we bought, right? Why didn't we sell? Why did we buy? Well, we bought because the commercials are buying, the retailers are selling. We have to buy. There's no other argument around it, right? So the technicals, because in terms of the technicals, I always have two options. I can sell with the trend. I can find supply just as easily as I can find demand. However, when we apply our technicals have to confirm our fundamental biases in the market. Let me repeat that and write this down. When we apply technicals, when we apply an analysis of price, the analysis of price is only for confirming our fundamental biases in the market. How do we get a fundamental bias in the market? Who do we look at? Well, it depends on the market. But if we look at the finite market, for example, life doesn't get much easier than looking at the commercials and the retailers. And yes, it's not going to be right all the time. We're going to be wrong. We're going to be too early. But with following the commercials, we follow the most consistent player in the game. Okay, and that's what we want to achieve. We don't want to achieve 100% accuracy. That's not realistic, but we want to optimize our accuracy as well as optimizing our profitability. So we can optimize our accuracy in consistently following the blue line, which is the smart money. And with that, however, I have not optimized my profitability, my risk to reward. How will I optimize my profitability? Well, I'll optimize that only within the third step of the process, of the supply and demand process. And I'll optimize that in market timing when I look at the size of my zones, because I could buy palladium from here to here, right? And then my risk to reward price would have to travel a lot for me to have a decent risk to reward. Or I could look to time the markets maybe like this. And then as price rallies potentially higher, I have a much better risk to reward. So step 3 of the process, and that's why it's the last step, will then be around optimizing profitability. While now we're still talking about the context, now we're speaking about the fundamental context. In the last module, we spoke about the technical context on the higher time frame, location and direction. So location and direction plus fundamentals, in this case commercials, equals this is a market that sets up very well at the moment. So hey, let's just pay attention to that. And as we pay attention to that, let's go into the third step of the process and look to time this efficiently with a quality risk to reward proposition. Okay, these are the steps that we will undergo. So if you still think about this on our first lesson, right? Our first lesson of the strategy course, we talked about these are the questions that we have to ask. Can we forecast a major rally or decline? Well, what are we going to look at? Depending on what market we are trading, if we're trading a finite market, then we're going to look at the Campus COT index and we're going to look at the commercials. And then when is that rally or decline most likely to happen? Well, we can then look at the true seasonality to argue the best calendar week or calendar month to be buying palladium. And then, well, where are we predicting price to turn? Well, that's where the technical comes into play. What is the best price to buy and sell in terms of the location, the higher time frame, and then also the lower time frame? And then later on, we can further optimize that through our strategy Campus Trade Optimizer, through a software that we developed. So these are the steps. So it all boils down to the following. The main objective for us is to see what the big boys are doing in the marketplace. And then we want to align our analysis with them so that we are not buying when they're selling and we're not selling when they're buying. This is what the retailer do, right? We don't do that. We don't sell when they buy and we don't buy when they sell. We align ourselves with them. What we found in the examples that we did is that the COT report data, it has to be looked at relative to what is happening in the market right now. So what we need is we need an anchor point that's reliable. And then we need to compare our current positioning with that anchor point to be able to argue with high probability whether the commercials are in fact bearish or bullish in the market. So in terms of wording, it all boils down to this. Okay, so when commercials have been buying a lot over months and years, our index will be high. And as our index is high, it will set up a buy signal for us. Okay, so if the commercials have been selling a lot over the past months and years, then our index eventually will be low. And as the index is low, it will set up a sell signal. So the key is to look at a time frame that commercials usually use to transact their business on. So this usually varies between 6 months and 3 years. Okay, it's not a coincidence that we use 6 months and 3 years. This is just what a major strategy backtester told us to do, that most of the time these are the best anchor points. However, and as we go into practical applications, maybe next week, there's nuances where this may vary depending on market to market. That has to make sense as well, right? I cannot give you a magical cyclical anchor point 6 months and 3 years that's going to work for every market exactly the same way, because all markets, even though we categorize them into finite markets, all markets are different. So what we have to figure out is, again, we have to figure out through a lot of screen time what works best for what market. For some markets, I can tell you the 6 months time frame, the 6 months anchor point is just total garbage, right? You don't even need to look at it. And we just look at the 3-year and higher for some markets. And how will you spot that? You will spot that as you look at the index, and then you look at how this interplays with chart and the trend condition. You do the back testing just like we did together. And then you can argue based on your back test whether this in fact is working or whether that in fact may be garbage, right? And if it's garbage, then either we have to change the inputs or it's just not an indicator that we can use for that specific market. So what I don't want to do, and what I had originally planned, is I wanted to speak about some other markets like coffee and like wheat and maybe like gold and silver. But what we're going to do is we're going to save that for next time. And we covered quite a lot today in terms of just generally how all the puzzle pieces here are falling into place. And as we do practical applications, we automatically will talk about trend. We automatically will talk about location as well. And potentially we'll see and we'll find together major market setups in our finite market category. Zina, let me just read that out, what Zina is saying. Zina, do you have commercial experience? Zina is saying it makes sense on the time cycles, users and producers. Annual planning is 6 months to a year, right? Of course, they want to plan for the year ahead and 6 months, shorter term. And then strategic planning and cycles tend to be 3-year strategic plans. So take this from someone who has a lot of commercial planning experience, budget, procurements, etc. So that makes sense, right? That makes sense. Perfect. Thanks for that input, Zina. That's great. A long time ago, Bash. All right, so I'm going to stop the recording here. Feel free to hang around and ask questions. Thanks again for watching, staying until the end. Happy and safe trading, and I'll catch you all in the next days.